Welcome to PIMCO Pod. In this episode, we discuss strategies to strengthen and diversify portfolios need to adapt to a world where geopolitical risk is a feature rather than a bug. Stay tuned after the conclusion of the podcast for additional important information. When Geopolitics Becomes an Economic Input by Mark Seidner and Pramal Dawan. Markets have long struggled to price geopolitical risk. Part of the issue is that each flare-up tends to be viewed as a one-off volatility jolt to be weathered and then faded once there is resolution. Today, however, geopolitical risk is no longer a series of isolated events. It's a defining feature of a more fragmented, multipolar world. For more, see our 2025 Secular Outlook, The Fragmentation Era. Multinational institutions no longer function as reliably as they once did. Stability has eroded. Perhaps more than ever, geopolitics directly shapes trade flows, supply chains, industrial policy, energy security, defense spending, fiscal policy, inflation, and growth. In other words, geopolitics is now an essential economic input. As a result, it is an increasingly important input into investment decisions as well. Passive investment strategies were well suited to a world of low geopolitical risk, central bank balance, sheet abundance, and compressed volatility. That world is gone. In its place is an environment that distributes risk unevenly, creating distinct winners and losers across countries, sectors, and asset classes. Navigating that dispersion requires flexibility, the ability to rotate, adjust, and exploit dislocations that a passive index, by construction, cannot. In our view, agile multi-sector approaches are best positioned for this environment, where it will be critically important to price risk objectively. Successful investors will need to discern across multiple sectors and security types, as well as liquidity profiles, to choose the best risk-adjusted opportunities to deliver returns. Start with the starting point. It's tempting to view recent conflict-driven volatility through the lens of early 2022, when Russia invaded Ukraine. That year's energy shock hit a post-pandemic global economy marked by pent-up imbalances, while bond yields were near all-time lows. As inflation surged, stocks and bonds sold off together, correlations spiked across asset classes, and diversification appeared to vanish just when it was needed. The defining difference between then and now is the starting point of yields. Bond yields are much higher today than in 2022, providing far greater cushion for investors. As a result, even during recent stress, fixed income has demonstrated a greater ability to absorb shocks. Lean into dispersion. Geopolitical volatility doesn't affect all countries or asset classes equally. Broader market performance, or beta, matters less when winners and losers are increasingly distinct. Geopolitical fragmentation rewards selectivity. This can be observed today within emerging markets, for example, where the lines of differentiation and resilience are increasingly drawn between energy exporters versus importers. For more, see our March 2026 Cyclical Outlook, Layered Uncertainty, Conflict, Credit Stress, and AI. Targeted tools for inflation hedging. Since the Middle East conflict began, inflation has been a foremost market concern, highlighting the role that inflation-linked bonds can play in portfolios. For example, in the U.S., Treasury inflation-protected securities, TIPS, can be an effective tool. However, they also draw occasional criticism during volatile periods. When real, inflation-adjusted yields rise, longer-dated TIPS prices can still fall due to interest rate risk, even as inflation risks increase. Approaches that emphasize shorter-dated inflation-linked bond exposures and more targeted tools, such as inflation swaps, can enhance the inflation hedging properties in portfolios. This can better isolate inflation mitigation while managing sensitivity to yield movements. Look for opportunities in commodities. Over the past couple of months, one asset class behaved largely as theory would suggest: commodities, which have seen large price swings and often sharp gains as inflation expectations rose. Importantly, outsized short-term volatility tends to reset risk premia, or the amount of compensation investors receive for specific risks. In commodities, this has created tremendous longer-term opportunities, particularly for investors focused on relative value. For example, across commodity curves and cross-commodity relationships rather than directional bets. Conclusion: building resilience for an age of geopolitical volatility. To strengthen resilience, investors should construct portfolios to adapt to both episodic shocks as well as structural shifts in a more geopolitically driven market environment. Over short time horizons, particularly during bouts of stress, correlations across asset classes can appear skewed and diversification may seem elusive. Yet, when portfolios are built for long-term resilience, diversification can reassert itself. Flexible multi-sector strategies, dynamic bond funds, and income-oriented portfolios are built for precisely today's regime. These strategies can lean into dispersion, pursue targeted inflation mitigation, and capture relative value. This is a world that rewards the adaptive and penalizes the rigid. Flexibility isn't just a feature of good portfolio construction today. It is the strategy. Thank you for listening. That was When Geopolitics Becomes an Economic Input. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.